Hello, good morning. And today is May the 17th. We've had another week of excitement in the stock market. A lot of things happened that we didn't really think would happen. But the news was good from Geneva, and the US delegation, with Bessent at its head, managed to do some sort of a deal with the Chinese. The problem is, just like the UK deal, that nobody knows what it is. Nobody really knows what the deal with the Chinese is going to look like either, because they keep on punting it in the long grass and really feeding the market with a whole load of hopium. What they did do is reduce the China tariffs from an impossible 145% to somewhere, who knows, below 50%. Around 30% is everyone's guess, but nobody really knows. And that got the market euphoric, because I guess the market was underpricing the possibility of this happening. Also, what we had all week was the negotiations up on the Hill about the one big beautiful bill, which the market has been pushing and hoping would pass with very, very expansionary policies. I think that probably got a dose of a cold shower on Friday when the bill did not advance in the House, and also when Moody's, one of the three rating agencies, downgraded the US debt down to A1 from AAA and joined the other two rating agencies in downgrading the US debt, which in no way can be seen as good for long-term US bonds over the long term. I guess more people will now deleverage their US dollar positions, but I don't think it's that significant, because all they've done is joined the other two agencies. So everyone is now on the same page, as it were, and the US debt is no longer AAA. What are your thoughts about that, Andy? Because I know that you have some pretty definitive opinions about it.
Yeah, I'll come back to the Moody's thing, which I think we will find out how it plays out. But I think what I'd like to do is just start with saying long-only portfolios for the course of this year have had relatively high volatility, particularly the 60-40 portfolio, less so those that have more balance, that have gold in them, for instance. And really nothing has happened. The average long-only portfolio basically has returned cash with high volatility. And so we've essentially avoided that. Have we traded it well? We'll see. But our basic views have been that a combination of interest rates, long-term interest rates, and high risk premiums, higher than normal real rates, or higher than recent real rates, a Fed that's on pause, and a fiscal policy that, even with the heavily downgraded tariff expectations and the heavily downgraded DOGE budget deficit reduction expectations, is still anti-growth in its nature. That's where we are. We went through a period of extreme volatility where equities fell 20%. Bonds rallied and then fell based on a much more aggressive, and then further extrapolated by market participants, view that the economy was heading into a recession, a disinflationary slowdown. That was an extreme view. It was driven by policymakers and extrapolated by market participants. Today, the same thing is likely true, which is a disinflationary or modestly inflationary expansionary policy is now being discounted by markets. Bonds are trading at their high yields. The central bank is now being pressured by markets to reduce the amount of cuts it plans on making, which we'll find out when they meet in June. And equity markets are back to their levels they started the year at. with NASDAQ doing slightly better and Russell doing slightly worse. The dollar remains weak still. Gold remains strong still. But from a standpoint of equities and bonds, we're now basically where we were in January. And so when I look out and think about how we have been describing to you all our outlook has always been that all of these tightenings, fiscal and monetary tightenings that had been in place in January and are currently in place, in our view, today, should generate a growth slowdown. However, that growth slowdown was wildly impacted by the hard data, and even the sentiment data was wildly impacted by the tariff news, the front running of the tariff news, the likely subsequent whipsaw back from the tariff news. And we didn't predict that. That was, unpredictable. Trump Liberation Day was far more extreme than anyone had considered, including the central banks. And the reversal was equally hard to predict. So what was our view? Our view was that sometime now in May for the April data, which is still on the cusp of it being where we would expect data to have weakened, but certainly June for the May data, was where we expected a window of weakness. And to be honest, our views haven't changed at all. Now, could we have bought the bottom and sold the top and outperformed the market? We've been conservatively positioned and in a heavy amount of cash-like instruments for a while. And that seems pretty much where we want to be. As it relates to the specifics of the Moody's downgrade, there is a technical reason why the Moody's downgrade could influence markets, but is highly unlikely, which is that certain participants must have at least one AAA rating to hold, to accept as collateral for borrowings, or to hold as part of their investment thesis. The process will, now that none are AAA, the process will be to change the rules more so than it'll be to dump the assets. But some people will be forced to at least pre-prepare in case the rules change don't occur, and sell some U.S. Treasury assets and demand other collateral. So just looking back, this happened 3 times. This is the third. The first time was in 2011. There was a lot going on that was not related to this thing. The only thing that was common was there was a debt ceiling and an unresolved budget. The S&P started by putting the U.S. on credit watch and then downgraded. In that case, equities sold off 20% and bonds rallied, long-term bonds rallied 20% in the weeks to follow. Could that happen? It could, but again, lots of other things going on. In 2023, with a debt ceiling and unresolved budget, Fitch downgraded the United States, and equities fell 10%, 11% on the S&P, 23% on Russell, and 12 or 13-ish% on NASDAQ within 90 days. And in this case, unlike the 2011 case, long-term bonds sold off 17%. So in both cases, equities sold off quite a bit. Again, other circumstances were different. The only thing common is the debt crisis and the continuing rise of our national debt. Those are common things. Everything else uncommon, but that's what happened. And so it's unclear what will happen to bonds. Equities seem like they don't like this type of uncertainty and negative outcome, but there's a lot of good things going on, as we've been saying, regarding the equity market with a more expansionary than expected budget. Not a lot, but more. And less tariffs. And so the equity markets rallied all week on those factors and may have some give back in the coming week based on the otherwise negative outcome of a Moody's downgrade.
Right. So in any case, you don't really want to own long-term bonds. So we are conservatively positioned exactly where we want to be at the moment. The one negative would be that the Fed in this environment probably cannot ease, and therefore the short end has got another 20, 30 basis points that it could give up and go back to where Fed funds are and trade on top of Fed funds, which wouldn't really hurt us because we would make more in coupon, or just about as much in coupon as we would lose on the interest rate move. So we're not particularly worried about that, are we, Andy? The one thing that to change the portfolio now seems to be very, very silly, because we don't know whether the budget will be passed, A, and we don't know, B, if it will be as expansionary as the market is expecting. Both seem to be, one is very good odds, i.e. they will pass something, but that they will pass it as expansionary as it is at the moment after the Moody's downgrade, and the fact that that will embolden the hawks in the House seems to be very low odds. The compromise, whenever it comes, and odds are that it comes sometimes in August, right, because they always leave it to the last possible moment, must be that it's less expansionary than it is at the moment, and therefore it doesn't favor equities as much as it's priced in currently. So in either case, we want to wait and see what the outcome is. But let's talk about what we want to see to change our allocations, i.e. we need, at some stage, we will change our minds, right? But what would change our minds as far as you can see at the moment?
Right. So let's just start with the assumption that the big sell-off in the second half, the first quarter through April 8th, was due to policies that were clearly anti-growth, which was very high tariffs and very high expenditure cuts. Okay, maybe that's not going to happen. The question is, what will happen? Are we in an environment in which the Trump administration will do what it takes to guarantee strong growth for an extended period of time? How would they do that? They would, in terms of what's coming in the near future, they would get this budget passed as written, which is going to be tough. And there is no forcing mechanism besides mean tweets and threats to the hawks in the Republican Party. There is no circumstance where they're going to get the Democrats to participate in this thing. It's all on the Republicans. And to me, there's going to need to be a forcing mechanism, and that's mid-August. So we're going to have all this uncertainty. However, and this is the point to Nick's, what are we looking for? If the budget hawks pass the current modestly expansionary and certainly more expansionary than expected budget, that would be a normalization and would favor adding equities. But we still have a Fed that's on hold, higher long-term interest rates, and a significant potential that those things on their own will cause a modest slowdown. That's what we've been expecting. That's what we've been telling you. If that were to happen, it would show up in the data. So we will be on data watch starting in probably late-ish May through, which we're in the midst of, into late June for data that shows no slowdown. And in the event that there's no slowdown, I don't think that'll make us bonds attractive at all, but it will allow us to normalize our equity portfolio with more confidence.
Right. And what I'm looking at myself is real rates. I think real rates are going to be extremely important here. I traded real rates 2 years ago extremly well. I bought 255 in 10-year notes and I sold 155 the same, and basically, topped and tailed it. And now I'm waiting for a new high in real rates. I think if real rates get to anywhere close to 3% on 30-year notes, I don't think that this economy can really take it. I think that the slowdown would then become guaranteed unless we get, I don't know what needs to happen for the economy not to slow down with 3%
So
real
let me
rates.
rephrase that. In the event that we were to have real rates back up, presumably it would be on expansionary growth, which would, for the moment, be bullish equities and maintain equity earnings, increase equity earnings, etc., which means that equities wouldn't necessarily fall. But then once they get to 3%, the economy just can't hold, the economy itself can't hold those types of growth expectations. And so on the way to 3%, maybe it's okay to own equities, but we've said lots of reasons why we're going to wait. But once you get to 3%, does that mean you buy equities or does that mean you don't buy them?
I think it means you don't buy them, because I think at that point you have to have a switch into long-term bonds, and simply because you are bound to get risk off. You have to have a significant slowdown in growth prospects, and not just for this year, but going forward. Continuation at 3% real rates, I think slowly just drowns this economy, holding its head underwater.
Which means that the bull case for equities is real rates stay high but don't go much higher, and which allows equities to both get good earnings and not have this tightening. And that'll depend on, of course, inflation and whether real rates are being pushed up by the Fed turning from cutting to hiking. And that's hard to tell. If the Fed is unwilling to hike, real rates will rise and that the market will slow the economy on its own. If the Fed is willing to hike, but not hike too much, that's when equities can, that's Goldilocks. That's when real rates, long-term real rates, stay low enough to support equity prices and earnings. And so it'll depend a lot on policymakers when and if they respond to this lower tariffs than expected, more expansionary economy, and begin to discuss hiking. If they stay dovish, real rates are going higher, and that's not good.
Right. So let me try and distill our views, and you tell me if you agree with me. I think real rates are going to remain high. The question is, do they get high enough to kill the economy? But that is not a question for today. That's a question for many months from now. The real question is, what does the real data show in the next month to 6 weeks? Does it show any weakness? If not, then equities are likely, even if they do give up 2-3% because of this downgrade by Moody's, and we'll see over the course of next week if it happens. Personally, I don't think it's going to be very profound. If it does happen, I'm only looking for a few percentage points, certainly less than 5. If that were to happen, that is probably an opportunity to see if you can pick up something, some calls or something like that, especially on an asset like QQQ, betting or not betting, but hedging yourself and not having a 10% allocation anymore, but having a 15 to 18% allocation in equities, and seeing if the real data does not weaken, then the equities will rise into probably all the way into August. And if the budget is passed, as it is, then you get a second leg of a rally in equities, which probably takes QQQ certainly to new highs. And at least you've hedged that portion of the bet. But once real rates reach the 2.85 to 3% area in 30-year notes, then basically you press the nuclear button and you get rid of all your equities and you go 100%, almost 100%, I'm exaggerating now, into real rates, because that is all you can hold when 30-year real rates are 2.85 to 3%. Would that be what we've been saying? And I've just distilled it in trader terms.
Sure. Right. Normalize the equity allocation back to a very low equity allocation opportunistically, as long as the data doesn't disappoint. Pay attention to the budget, but it's going to pass. But frankly, it's not going to pass anytime soon. Watch the tariff news and recognize that we are in an administration that for now is comfortable pumping growth a bit.